A few weeks ago, I shared a short term trade in Tesla on why I was going to work out, or the thesis of why I was working out, and also positioning on the put side that was looking for a short term move lower. Now, what I'm seeing is something completely different, but it's still setting up for a short here. But I'm going to show you a strategic way of using options that a lot of people are going to shy away from. But I'm going to walk you through why the big risk is where the big returns are, and just understanding how to manage it and waiting for that setup. But before we get started and share that trade with you, I just still want to share my thoughts on Tesla cars. And every time I see one, they are still ugly, and I would never own one. I just want to get that out there, just in case. Just in case you own a Tesla, you don't like what I'm saying, you could take the other side of this trade. But what we're seeing here is shares very weak and look to break lower. So let's take a look here at Tesla. Tesla here on the 1 day year chart here, and you're going to see me on a different position here. We're going to look because we're going to look at implied and historical volatility at the bottom of the chart here. So, anyways, what we're seeing here, what I'm seeing here, is Tesla hasn't been talked about. We have Bitcoin, we have the meme stocks. It's just fallen out of favor. The interesting thing, though, on this is that it is still a hard to borrow stock. Does it mean it can get squeezed higher? Possibly. Does it mean that it could break lower? Possibly. And here's the reason why. One of the triggers that I have noticed from back testing is when something is below the 10-day and also breaks below the 200-day, so it closes below the 10-day and is below the 200-day, which is exactly what happens here, we see some volatility. We can kind of go back and look at a couple of instances. This is good. This would be one instance back here, and we would have to go back a little bit further here, where the 200-day was meeting here, but we would have to go all the way back into the past here. So it's not something on this specific chart or this specific stock that it's happened quite often here. But what we're seeing here is we're kind of getting a drift higher. It's following this 200-day moving average here, and my assumption is that we are going to break lower. It's a very weak stock. It still, yes, could have a catalyst of shorts being squeezed, but that has happened previously for the last several years, which has taken it to $900 a share here, and that was after it split last year or the year before. So anyways, the other thing I'm noticing as well is to keep in mind is that we've seen historical volatility drop to lows here. We're also seeing volatility. It did tick up today, but volatility is relatively low compared to what we're seeing to the left of the chart here, which means that we could see price volatility come into this stock here, and it could either move prices higher or lower here. So that's where I'm going to walk you through an idea here on what I was looking up here. So again, for trades, we're always looking for a thesis, and we're looking then for trade structure. So now, the reason why I wouldn't just get short this name is because there is a bit of a wild card here. And now the other part of that as well is that some people, well, not some people, let's back up here. Sometimes it's better to buy options here, and sometimes you have to find the right opportunities to get long straddles or strangles. What here we're looking at here is a strangle, and I went out to 17 days here, and I'm looking at the 617. So I'm looking at a 40 delta on the call side, and I'm looking at a 40 delta on the put side here. And the reason is because I want to capture the meat of the move. If we see prices gravitate higher, likelihood of volatility coming in is going to happen. So we need price to accelerate higher, the delta accelerate higher on that to really offset that. But if we get that big move higher because of a short squeeze or whatnot, that could happen. But at the same time, prices do typically move faster lower to the downside, which then would increase volatility and increase the value of this debit here. So we're looking at about a $40 debit. Yeah, I mean, it's an expensive trade here. My targets on a $40 debit would typically be about 20% of this debit, and I wouldn't be in this trade more than 10 days. So this is a trade here that we have 17 days here. I'm looking for this to play out in the next several days, the next 10 trading days. We have 5 trading days. Well, 17 days, but we're looking at 10 days to get out of this. So anything before 10 days, get out of it. Anything that happens where we get a 15 to 20% profit on this, I would be looking to get out of it. So something on this one, we have a couple different things that can happen. You can buy this strangle and volatility could increase. You can buy the strangle and volatility and also price go in your direction as well. So there's a couple different ways and a couple different things that happen with this specific strategy. This is a little bit more in depth. A lot of individuals are going to show you some cookie cutter ways. You could buy a put, sure, you had time decay on it. You could buy a debit spread, but now you're buying one implied volatility and selling one that's lower. That's the trade-off. You can do that. If you like my thesis or what we covered and you want to get short, you could do that. Get a put spread. Go out to 30 days. Go out to something a little bit further. That could be something to look at as well. There's a couple different ways to do it. You could sell a credit spread. There's all different ways to structure a trade. You have to look what's best for you. But the core of this is oftentimes people shy away from taking the big shots or taking on positions that have opportunity to benefit them because of the price. It's too much. Now I know that $40 debit is a big chunk of change for some people. That's why sometimes you may have to structure it a little bit differently. But hey, that's not what I'm here to sugarcoat stuff. I'm here to show you what could work, and then you can decide what you want to do. So that's what I have for you. Let's see what happens to Tesla in the next several days, and what I think is going to happen, and it breaks lower. But listen, it could be wrong, and if this trade, and on this trade, if I am wrong and it shoots up higher, well, yeah, I'm wrong, no big deal, but it will still benefit because a strangle here, longest strangle, profits if prices go higher or lower. What we don't want to have happen specifically is for it to continue to trade this way and see volatility drop out on this. So that's what I have for you. A little bit different today, but it's the advantage of being strategic with options, creating opportunities like this, waiting for signals or waiting for opportunities that, like on Tesla here, haven't happened too often, but that's why every product is different and every setup is always different as well. See you in the next one.